But if you look at the relationships between this high in euro and then the lower high forming over here, it fails to make that equal high or higher on this run up. At the same moment over here, we have cable creating this high and then making a higher high. And this is what I teach as SMT. You can also see this divergence inside of this high to this high being higher, but not seeing the high being met with a higher high here, it's lower. So these two price points are signifying that there's a cracking correlation here, and this is distribution. We don't know for certain, it's just a qualifying or selection tool. And then I like to see it support that premise by moving in that direction and then getting in sync with it later on. And what do I mean by that with this divergence? Well, we can see that euro was unable to make a higher high here, whereas cable or pound dollar was able to make that higher high. This indicates when the market is bearish that this is a stop run, and it's also trading back up into a fair value gap. Here, this is an internal range liquidity where it could be a rejection block, fair value gap, or bearish order block. This isn't necessarily better than this. The difference between trading euro over cable in this context is this. Watch. If you look at the euro dollar, and this is that low that was in place before the FOMC announcement, where they ran up price like this. This is a central bank repricing. You don't want to stand in front of that unless you know exactly what you're doing and you've taken something off earlier in the week. You can leave a small portion of the trade on and then ride that out. You don't necessarily want to trade ahead of it because you don't know what the central bank's going to do with FOMC. You have no idea what they're going to do. I don't know. Just like you don't know what they're going to do with non-farm payroll. The numbers might come out that supports a currency move higher or lower, but they go the opposite direction. But anyway, this low here, that is the low that would have been targeted if all of this was tomfoolery. Okay, in other words, the manipulation just ran up just to go down. The market trades lower and creates this SMT divergence. Remember, I was showing you before we went to the slide, it's the same thing. All I'm doing is referencing this high to that low. And it's basically saying that it's 51 pips, 51.1 pips. But if you look at cable, it's high where it diverged to that same low. It's 108 pips, or 108 and 3 pipettes. Which pair offers the most in terms of potential? Is it selling short from here to there? Or is it selling short here to there? Which one has the better setup? Clearly, cable. Here is the euro pound. Now, in your notebook, if you have not made this reference in your notes as it relates to cross pairs or cross pair analysis, whenever the dollar index is in consolidation, and yes, it's in consolidation, then you want to be referencing the crosses. That means like euro pound, pound yen, euro yen, those types of. You don't want to look at the dollar crosses. Take the dollar out of the equation and go right into foreign currency versus foreign currency. And then you'll start seeing these types of moves here materialize when they normally won't if the dollar's moving. But if the Fed is holding dollar in consolidation, then your attention needs to be moving to this pair, at least while in mentorship and under training, because you'll start seeing this pair will move. The rejection block here, it trades down into that, into the low of the day. Then market runs higher and takes out this short-term high. So this is now a bullish market structure. It trades through a short-term high and then trades back down into a fair value gap and a bullish order block. So we have institutional order flow entry drill and bullish order block. Price rallies, but it trades higher from there, attacks the buy side liquidity here, ultimately trades up into these relative equal highs and into the bearish order block, which is the last bullish up close candle with the highest close and big beefy body. Trades up into it there at London close. So while this pair is bullish, okay, what does that technically mean for us? Well, bringing in algorithmic theory, if the dollar is consolidating on the daily, okay, if your daily chart's consolidating with the dollar, and it is, and intraday dollar is bullish, okay, if the dollar index daily is in consolidation but its intraday chart is bullish, then euro pound analysis is required. If euro pound is bullish, as we show here, then euro dollar is strong to neutral, or pound dollar is weak to neutral. Now, what does that mean? For this pair euro pound to go up, one of two things have to happen. Either the euro goes higher while the pound stays in consolidation, or euro stays neutral while pound goes lower. That's the only things that can happen that makes this pair go up. Now, furthermore, if euro dollar is neutral, then pound dollar is weak. So we have went through algorithmic theory to ferret out which pair has the largest magnitude price move, which one is unlikely to have a big move, and that's being euro dollar, and that makes the pound dollar the better day trade as a short. All right, here's the euro dollar 15-minute time frame. You see London high during the London open kill zone, due to swing higher. Price breaks down. Down close candle right here is your breaker. Draw that out in time. Beautiful delivery up into New York open. Breaks down. Optimal trade entry hits the low end of the breaker or discount low. Price breaks lower and takes out that short-term low prior to FOMC, and then ultimately moves approximately 10 pips below the short-term low prior to FOMC run-up. All right, pound dollar. This is a 15-minute time frame. The 60-minute breaker is framed out over here. Now, this is a 15-minute time frame, so don't be confused. And on a 60-minute chart or hourly chart, find this breaker here, which is the down close candle or down close candles, the highest high and the lowest low of those down close candles, and you'll see those prices over here. So that'll help guide you. This extent is in time, and I mentioned that these relative equal highs have buy side liquidity resting above that, and it might send price higher because it's Friday. They might send it up into deeper into that breaker. It does so in London Open. This is exactly what IPTA tends to do. I gave you the day of the week, the profile it should operate under. It rallies up into, just falls like a pip short of the high end, touching the breaker's premium high, trades just short of that, and then breaks down, creating the high of the day, trades back up into another fair value gap, trades into the bearish order block here, into the fair value gap once more, sells off, hits the bearish order block here, and cascades lower, taking out this sell side liquidity pool and attacking the low prior to the FOMC. Ultimately crashes below that low in the tune of 20 pips for a 20 pip sweep below the FOMC low. And then London close, we start to move back up inside of the range and closing in this small little imbalance right there.